For long-term investors, a stock market downturn doesn't necessarily spell doom and gloom. This is a moment to hold firm to your investments rather than selling off. The decline itself may even represent a chance to buy something. Buy the dip. When the market presents an opportunity, you can boost your profit by making a low-priced purchase. In circumstances like these, a smart buying the dip strategy is extremely beneficial. Here's how you can buy a dip. So, what's a dip? A dip is a decrease in price when referring to stock commodities, exchange-traded funds, or the ETFs, or any other type of financial asset. Think about a stock that was trading at $100 per share. It may now be at $95 or even less. The decrease is the dip. Simple. When you hear someone saying buy the dip, they're assuming that the asset will recover. Buy the dip is a trading strategy that applies the basic investment tenet of buy cheap, sell high, but with a little more focused approach. The stock price must have fallen significantly, and there must be a solid signal that it will increase again in order to qualify as a purchase of the dip opportunity. One of the more typical instances of this is when, as opposed to worries about the long-term success of the company, the abrupt decline in the stock price of the major organization is a result of widespread market anxiety. Trying to time the market is never a good idea because nobody can predict when the bottom will occur. Yet, if you're willing to invest for the long term and know where to look, there are many opportunities to buy equities during downturns. Buy the dip strategy. How does it work? The buying the dip technique is justified by the fact that markets never move in straight lines. Prices typically fluctuate in cycles, with multiple ups and downs occurring with longer-term trends. In order to find the cyclical low points that will likely offer the best price entrance opportunities into the market and exit during cyclical high points, a buy the dip investor must first identify the market cycle. This is known as buying the dip and selling the rip. Investors might look to several market cycles to time the market for entrance by buying the dips. Market cycles consist of 4 stages: accumulation, markup, distribution, and decline. The accumulation phase is the time for buy-the-dip traders to initiate trades, and the distribution phase is the time for them to exit trades. Also, there is the Dow theory-based 3-phase bull trend, in which traders aim to enter the accumulation phase, hold their position throughout the public involvement phase, and sell during the surplus phase. Market cycle can be identified by both technical and fundamental characteristics. The economy generally expands and contracts in 2 phases according to the broad fundamental business cycle. Employment data and GDP are 2 key metrics that help track the business cycle. Using several market technical indicators such as Fibonacci tools, one may monitor the subjective psychological phases of greed and fear. Investors can also use calendar cycles to determine when to enter the market when buying cyclical trading equities on the downturn. Both short-term and long-term market cycles are possible. The major drawback of the buy-the-dip stock approach is the lack of standardized method for determining the frequency and size of any market dip. It might be challenging to spot the finest possibilities in live market environment, despite the fact that looking at a chart after the fact may indicate several buy-the-dip opportunities in the market. How to buy the dip? Look at large companies that have experienced significant declines. Certain blue-chip equities that had previously been stable for years have recently been severely impacted by a confluence of the global pandemic, rising inflation, and Federal Reserve interest rate increases, and their valuation have yet to recover. It may be possible to purchase shares of huge firms at their lowest price in years by keeping an eye out for such declines. The use of individual stocks, which can be more volatile and risky overall than more diversified investments such as mutual funds, exchange-traded funds, or index funds, comes with a warning, so use caution while choosing them. See the market that suffered the most during the sell-off. A few possibilities to buy the dip may be revealed by looking at the industries with the highest share price decreases and then research the mutual funds or exchange-traded funds that track those industries. Make use of dollar-cost averaging. Consider making continuous investments at regular periods rather than a lump sum contribution at the time you believe is most advantageous. Do this if you have an IRA or other investment account. You'll keep buying shares during the slump by employing this method, referred to as dollar-cost averaging. Make the most of your 401k. When the market is down, investors might be encouraged to contribute the maximum allowed under their 401k plans, providing they have secure employment and sizable emergency assets to fall back on. By increasing your contribution, you are essentially purchasing more shares of your existing investment at a discount. The lower share prices would nevertheless allow you to receive more shares per contribution, even if you kept donating the same amount as you had before the downturn. The last thing you would want to do is stop making contributions during a slump unless you actually need the extra monthly income flow. You buy the dip. Does it really work? Buying the dip offers benefits and drawbacks, just like any other financial approach. The possibility of big profits is the strongest argument in favor of purchasing the dip. Buy and hold investors who are unconcerned about market price peaks, and troughs underperform buy and distance investors in an uptrend. Market reveals are constant, and they present chances to save money. Long-term investors who buy the dip can also lock in low average price for their preferred assets. Also, this helps to increase your profit margin. The trading approach is also perfect for certain markets that are prone to long-term high-value declines. Example of equities that present worthwhile dip chances are technology stocks, cyclical sectors like hotels and commodities, as well as growth stocks with a propensity for high volatility. Furthermore, receiving a discount in the market provides a psychological kick. By purchasing the dip, you will at the very least have the satisfaction and pleasure of knowing that you did not pay the asset's highest price. Timing the market or buying the dip both have inherent risks. Quantifying the size of a downturn is particularly challenging. A dip can have a reason, and you might find yourself in the middle of a raging bear market. By waiting for the market correction, you run the risk of missing out on significant gains during a strong rally. In general, it might be difficult to tell the difference between a market price drop that is only transitory and the beginning of a downtrend. Limitations. Buying the dip has limitations. It does not ensure that you will enter the market at a deep discount. Today's low could become tomorrow's high in markets. All that it really implies is that the prices are significantly lower than they were a few months or weeks ago, giving investors the chance to buy at the comparatively low price. If you think share prices will eventually increase to or surpass prior highs, buying at today's lower prices may be a viable strategy for creating long-term profits. You may just have to endure a few significant declines before you see them, though. The risk. A major caution is that a dip could change into a falling knife. Until any trace of an uptrend is lost, the price of a stock can continue to decline. This could put you in an awkward situation if you're holding onto a position. It's crucial to be ready for such a situation in advance for the following reasons. Number 1, assuming you're not trying to enter a short-term trade, make sure the asset you're buying has strong fundamentals. Number 2, if you must leave the market, be aware of the best time or place to do so. Number 3, keep in mind that there could be additional entry points into the market above or below the one you select. Number 4, instead of placing large wagers, make incremental purchases. Managing risks. If you do decide to try to buy the dip in a particular index or stock, consider the following. Consider the potential repercussions of holding uninvested funds. Be sure you understand what you're giving up and why, as you'll lose out on advantageous tax treatment and the opportunity for eligible dividends. Keep your percentage of the market out of the market to a minimum. Recognize that this is an unconventional approach when it comes to producing consistent after-tax profits. Although it may seem wise to buy the dips, the vast majority of the time it is wiser to remain fully invested at all times. Choose a certain price decline at which you're willing to deploy money. Timing the market means buying the dip. Timing the market can be quite challenging to master. Identifying and carrying out the acquisitions of a falling asset demands good technical analysis skills. Yet, while attempting such a sensitive maneuver, having a solid understanding of both fundamental and technical analysis will help you increase your chances of success. With that, you can now buy the dip.